So from multi-period we are supposed to begin now, right?
Uh, uh, multi-period. No,
Yeah.
we did that also. 39 one. We did that.
This one, reliable calculating value of a 3 period. This we didn't do. Yeah. So reliable motors, but we have done all these in level 1, but
Yeah.
we'll just do it all this now as well. Just quickly we can do. See, reliable motor shares are expected to pay dividend 1.5, 1.6, and 1.75 at the end of each next 3 years. So this is 1, 2, 3. 1.5, 1.6, and 1.75 at the end of each of the next 3 years respectively. The
Sir, we
investor
did this
expects.
yesterday.
We did this yesterday.
Yeah, we did this yesterday.
Acha, Gordon growth. We came to
Yeah.
Gordon growth also. So Gordon growth, one sum we did, right?
Yeah,
This one.
one some we did this down under
Okay,
also we
from
did.
here. Okay, from here. Okay. Calculating the value of fixed rate perpetual preferred stock. So perpetual preferred stock, what is the formula for perpetual preferred stock?
Dividend upon this rate.
Mhm. Perpetual preferred stock. So cost of perpetual preferred stock. The formula is uh, expected annual dividend payment divided by
Rate.
expected rate of return. Okay, so here dividend, this is payment, okay, not percentage.
Yeah, yeah.
So they said 6% of 100, that means
Six
6
$6. Yeah.
divided by the investors required rate of return is 9.5
9.5.
percentage. Just calculate this.
63.15.
Okay,
Yeah.
Gordon growth. See, these all, when please read this entire book. You should read it. It's very interesting. Okay, very
Okay.
interesting and self-reading only, easy as well. Okay,
Yeah.
you will get a lot of insights, qualitative analysis, like or understanding the insights or the logic, all that thing, which is very good. Okay,
Okay.
calculating the implied growth rate using the Gordon growth model. Suppose that the current price and the most recent annual dividend for Aurora Mining are current price and the most recent annual dividend. So current price is 24.25 and the dividend is 1.10 recent. If the
Yeah.
required return is 8.5, what is the implied growth rate? Okay, what is the implied growth rate? So again, P0 as per Gordon growth model, P0 is equal to D1 by R minus G. Okay, and it says that recent dividend is 1.10 and uh, recent dividend is 1.10 and then present value is 24.25.
Yeah.
If this is the case, then how do I do now? If the required return on Aurora is 8.5 percentage, what is the implied growth rate?
So
Growth rate we
growth
have to
rate.
calculate. Okay, so
So
I can rewrite this as D0 into
D0.
1
Yeah.
plus growth. So I know D0 now. R also I know P as well.
Yeah.
That's it. Then I have to just do some algebra
D.
here.
Yeah.
24.25
Yeah. Yeah.
uh, you
Is
know
equals to 1.1 into 1
yeah,
plus G.
24.25 is equal to D0
1.1.
is 1.10
Yeah.
into 1 plus G divided by R is 8.5
8.5%.
percentage minus G. That's it.
Yeah.
Can you solve this now?
Yeah. Wait a minute.
Yeah.
Sir, I got 25.35 G is equals to 0.961. After that, I'm multiplying the or dividing. The answer is not matching with this.
Okay, fine. Wait.
25.35 G is equals to that equation that the book is getting. I'm getting that, but the answer is not matching with it.
One. Hello? 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 Hello?
Hello.
1 minute. So
Yeah.
what did you say? The answer is not
So
matching.
yeah, I got this 25.35 G is equals to 0.961. Then I divided and I also multiplied it, but
You're
I'm not getting that 0.39.
you're not getting 3.8
Yeah,
percentage.
yeah.
Okay. So 24.25 into 8.5 percentage minus growth is equal to
Yeah,
1.10 into 1 plus growth.
yeah.
So what is 24.5 into 8.5 percentage?
24.25 into 8. It's 2.06125
Okay,
minus
minus
24.5
24.25 G.
G is equals to 1.1 into plus 1.1 G.
2.06125 minus 24.25 G is equal to 1.10
Plus
plus
1.1 G. Yeah.
1.10 G.
Yeah.
So now 2.06125 minus 1.10 is equal to 1.10 G minus 24.25 G. So how much is this coming to?
0.96125.
0.96125 is equal to how much is this coming to?
23.1. Sorry. Wait. It's wrong. 23.15.
It is coming in minus, right? 1.1 minus 24. So,
Okay, yeah, minus, yeah.
so that is not possible. Now you are doing some calculation mistakes. Okay, I'll do it now. See, uh, so this is
Sir, this will come to plus, na? Sir, wait. So 24, it's 2.0615 minus 24.15. So if that 24 will go this side, it will be plus.
no, but this is G
Yeah,
1.10, and this is also G is involved here.
yeah.
So why will you take this left hand side? There is no G term.
Okay.
Okay, so I'll make it for 8 decimal now. Second format, and then decimal is 2 now. I'll make it 8. Enter. Clear work. 8 decimal. Okay, so 24.25 into 8.5 percentage. 24.25 into 8.5 percentage equal to 24.25 into 8.5 percentage. Why it is not showing any answer? 24.25 into 8.5 percentage equal to, it is 2.06125.
Yeah.
So 2.06125 is okay. Minus 24.25 G, then plus 1.1 equal to 1.1 plus 1.10 G. So this is okay. 2.06125 minus 1.10 is equal to 1.10 G minus 24. 1.10 plus, rearranging the terms, 1.10 plus 1.10 G, right, is equal to 2 point. This step is also right only. This step is there. Then see, this is the very silly. See, I have shifted this minus to here, so it becomes
Yeah.
minus. If I shift, it will become plus, na, here.
That's what I was saying, na, sir. That it will become plus. Then you said that the G terms, there is this G term, and it will not change.
No, I did not understand in this way. Then what is the problem then? This is plus.
Yeah,
Then
yeah,
what is the problem for?
yeah. After that,
Huh.
it's 25.35 G is equals to 0.96. This
So, okay, add it up, how much it comes to?
25.335.
35G.
Yeah.
So G is equal to now 0.96125
Point nine six
divided
one
by
two five.
25.35
Okay. Yeah.
multiplied by 100.
3.8%. Yeah.
Hmm. Okay. The next one, PVGO, present value of growth opportunities. So
Okay.
this is one formula, value. Okay. Now value of a stock is equal to E1 by R plus PVGO. Now how to understand this? You can think like, uh, E1 by R is equal to like no growth. Remember,
Okay.
we did that perpetual preferred stock.
Yeah. Yeah.
Now, what is that perpetual preferred stock? That means forever it is not going to grow. Forever it will give you only 6%.
Yeah.
So 6% divided by that, not 6%, 6 rupees
Yeah.
divided by the required rate of return. Okay, will give you the price of the perpetual preferred stock.
Oh.
Similarly, here also, this is earnings 1 with no growth divided by R. So if there is no growth, the value should be this much
Okay.
plus extra whatever growth, then again the value is increasing to this much. We'll see the sum, then you will understand. See, let's go through this question. Reliable Inc. shares trade at 60. So
Okay.
with expected earnings of 5 per share and required rate of return. Expected earning is E1
E1.
and
Okay.
required return is 10%. Suppose that shares are properly priced. So price is equal to fundamental value. Calculate PVGO and the portion of the leading PE related to PVGO. Okay. So first of all, it is priced at 60. Now
60.
we know if there is no growth only, what should be the price? So if there is no growth, it should be 5 they are going to get earnings.
Yeah. So 5 divided by 10%.
10 percentage. That should be 50 rupees.
Yeah.
So it should be 50 only.
Ah.
Okay. But it is priced at what? 60.
60.
So I can say this is for no growth, it is 50. And with growth,
It is
plus
60.
10, it becomes 60.
Yeah. So that 10
With
extra
growth, it
10.
becomes 60, 10 extra. So present value of growth is 10 rupees.
Yeah.
Okay. So this is the answer. PVGO.
Okay.
You understood? PVGO
Yeah.
is
Yeah.
10
Got it.
rupees
Got
now.
it. Got it.
Okay. Now the question is PE related to PVGO means PE ratio for PVGO. Okay. How much the
Okay.
market is willing to pay price for this present value of growth opportunities.
Okay.
So now growth is okay. So first of
10.
all, what is the PE ratio going on? See, PVGO is okay. This I wait. I get stuck here always. Wait. This much is fine. PVGO is 10. These two steps. PE ratio of the firm. Price to earnings. So price to earning is price is what? Price is 60
60.
rupees. Earning is 5. So 12.
But
So
that
12
is
rupees.
the dividend that they are giving, na? Yeah. Okay.
That is
That's
12.
got
That
it.
is
Got
the
it.
12. No,
Ah.
that is also fine. The last step, PV to PV, PE to PVGO. Uh, so how it is 10 by 5. Price earnings. Price earnings. This is based on, okay, this is PV to PE to PVGO means price earning based on PVGO. So, uh, price to earning is, see, how you should understand is this 10 rupees extra for uh, the earning is growing at the rate of 5 rupees,
Ah.
right? So market is giving extra 10 rupees,
Ah.
so 10 rupees extra for 5 rupees growth.
Okay.
Okay, so then that comes to extra 2 rupees the market is paying for every
So the
one growth.
actual P should be 10, but with PGO it's
it,
12
it is
because
it is it is only for growth perspective.
yeah,
Growth perspective, it is 10 present value of growth. And what is the growth happening? It is growing at the rate of 5 rupees.
5
Earning is
rupees.
5.
Yeah.
Okay, so for 1 rupee earning, market is ready to pay 2.
Okay.
Okay. Then 2 by 12 or 16.7 of the firm. Okay, so that means normal P is 60 by 5, which is
5,
12.
12. Yeah.
Okay, this is normal P, and this one P to PVGO. So PVGO is present value is extra
10.
10 market is paying for
Yeah.
every 5 rupees growth. So it is 2. Okay, now, so that means out of this 12 rupees, 2 rupees is contributed because of growth.
Okay.
So 2 rupees is coming because of growth. So 2 by 12, 16% of the firm's leading P is attributable to PVGO. So out of this 12 rupees, 2 rupees is because of the leading PE.
Sir, I did not understand this. Like P to PGO is a formula, na?
Aha.
So P to here we have 12 and PGO is 10.
Uh, See, overall, you are paying 12 rupees.
Yeah.
Out of that, you are also paying because of the growth expected.
Yeah.
Now we know that for one growth, you are giving 2 rupees extra.
Huh.
So out of this 12 rupees, your 2 rupees is extra.
Huh.
So 2 out of 12 is because of the growth.
Huh.
So that comes to 16.7 percentage is because of the expected growth. That's why leading PE. You take a minute and process this information. See, I'll repeat again. Overall, the general PE ratio is 12.
Huh.
That means to earn 1 rupees now, market is paying 12 rupees.
Huh.
Now
Huh.
that 12 rupees includes no growth as well as with growth. So with
Okay.
no growth, market is paying for 10 rupees.
And with growth,
And
it
with
is
growth,
paying
market is paying 12
12. Yeah.
rupees. So that means 2 rupees extra they are paying.
Yeah.
So 2 rupees is because of the expectations.
Okay.
So 2 out of 12, that means 16 percentage is because of expectations, 16.7. It's a
Okay.
leading PE.
Okay. Okay. Huh.
Is it okay?
Huh. 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 Got it. Got it. Got it.
Now next one. Now all these leading PE, trailing PE, which we have already done again. So this one, leading, trailing PE. In level 1 we have done. We'll just
Yeah.
quickly recap that one. So trailing PE first of all. Trailing PE is
Normal PE ratio.
trailing PE is so you using all Gordon growth model. So P0 is equal to D1 by R minus G.
Huh.
Okay, now dividing by E on both the sides. So when you divide by E, so here also it will be divided by E.
Yeah.
Okay, this step is okay. E0,
Yeah.
E0. Now that is equal to D0 by E0. This is into 1 plus G divided by R minus G. Okay.
Yeah.
Now this is payout ratio
Yeah.
into 1 plus G R minus G. That is equal to dividend payout ratio is 1 minus retention ratio.
Yeah.
So 1 minus retention ratio into 1 plus G divided by R minus G. Now that one minus retention ratio in your book it mentions retention ratio as B. That is the
B.
notation given.
Yeah.
So this is the final formula. You have to know all this. Why? Because in the question they might ask you this information is given. Then you have to use this information.
Huh.
Or this information may be given. So that's why you have to know all. But nothing for you to remember as such. It is
Yeah.
just you have to practice this couple of times. Okay.
Okay.
Then next one is leading PE ratio. Leading PE ratio. Leading again same base is Gordon growth. Okay.
Yeah.
Then dividing by E1, expected one. Okay, leading. So here also E1. So then dividend payout ratio. D1 by E1 is dividend payout ratio divided by R minus G.
Huh.
Okay.
1 minus B upon R minus G.
So 1 minus retention ratio. So 1 minus B divided by R minus
R
G.
minus.
So that this is the difference. Okay.
Yeah.
Leading one, 1 plus G will not come.
Yeah.
Okay. Now see this question. You want to write it down, you may write down. How are you doing? Are you writing it down later
Yeah.
on
Yeah.
watching the
No. No.
video,
No.
or you are immediately writing it down?
I wrote that PVGO thing. Yesterday I did not write anything because I already had all those things written. But I wrote this PVGO thing,
Okay,
and
in
I have
case
this this also written.
Okay. So in case
trailing
if you
entries.
want me to stop anywhere and go slow, you tell me. Okay.
Yeah, yeah. If I want, if I will write down, then I'll tell you to.
Yeah. Yeah. Now you go through the question.
Okay, so first they have given beta, so first we have to find the required rate.
Now, see. Now Alliance Inc. is currently selling for 16 on current earnings of 3. Okay, that means
Yeah,
its price is P0 is 16.
yeah,
Current earning is 3.
yeah,
E0 is 3. And your current dividend of 1.50. Current dividend. Okay, this is D0.
yeah,
Dividends are expected to grow at 3.5. That means 1 plus 3.5 percentage.
yeah,
1 plus G per year indefinitely. Okay, indefinitely. Okay. The risk-free rate is 4 percentage. That means R. No,
yeah.
not R exactly. It can be used to
RF.
calculate
Yeah,
RF. These all can be used to calculate return, required rate of return.
yeah,
Calculate the justified leading and trailing P. First, you calculate RF now, or R, required rate of return, is equal to using CAPM
yeah.
RF plus beta into RO minus RF. So R risk free. RF is what? RF is 4 percentage plus beta is 1.1. RM is market risk, equity risk, premium. It is directly mentioning
Yeah,
premium.
there.
Okay. So now
Yeah.
you calculate this.
10.6 is required rate.
Uh,
Hello.
1 minute, 1 minute.
Yeah,
12.6.
yeah.
Okay.
Yeah.
So this is the required return. Then uh, next one is
So they
now
have
we have to
given
just
growth
plug in the number, right? So P0 is equal to
D1
D1 by R minus G.
R
Now for
minus G.
trailing.
Yeah. So D1 what is 3.5, current
Okay.
dividend is 1.5. 1.5
Now
plus 3.5%
16 uh,
divided by 10.6.
D1 is D0 into 1 plus G divided by R minus G. Or if you want, you can directly write everything also. D0 by E0. And then you can see which one fits in. Dividend payout ratio into 1 plus growth is equal to 1 minus retention ratio, which I'll write as B. Okay.
Sir, here the answer is 10.6, not 12.6.
You mean
The
this
required
one?
rate. Yeah, yeah, yeah. That's 10.6.
That means you have done calculation mistake.
No, I said 10.6.
No? Okay. Okay then. Because I didn't calculate. Okay. Maybe I did not hear properly. Okay. So now,
So now, sir, we have everything.
yeah. So
So
current earning is 3. So D0, see, current earning is given, current dividend is given. So 1.50 is the dividend
50% is
divided
dividend
by
payout
3
ratio.
into 1 plus G. Growth is also given, right?
Yeah, 3.5.
3.5 percentage. So 3.5 percentage. Okay, divided by R minus G. R is 10.6 percentage minus G is 3.5. So you just solve this one.
Yeah, it's 7.04. 50% divided by 7.1% added.
7.04 done.
Yeah,
Okay. Then now leading P ratio. Leading will be uh, leading P ratio will be P0 D1 by R minus G. So divided by E1 divided by E1. So this is dividend payout ratio divided by R minus G. So that is equal to 1 minus retention by 1 R minus G. So here
so it will be the same thing that we did, huh?
yeah, but then here I have to take expected earnings. So earnings is also
So
uh,
1.5 plus 3.5%.
yeah, dividends are expected to grow at 3.5
Yeah,
percentage per year indefinitely, and earning expected earning also in the same way. Then so dividend is D1. D1 is 1.50 into 1 plus earning. D1 is 3. D1 is 3.5 percentage
yeah,
divided by E1 is current earnings 3. 1 plus 3.5 percentage whole upon R minus G. 10.6 percentage minus 3.5. Calculate now.
yeah. The answer will be same, sir. 7.04.
How can it be same? See, justified trailing is 7.29. 7.29. How did you get
So
7.04?
1.5 into 3.0 into this the growth. This the numerator answer I'm getting point 0.5 again.
I think you have done some calculation mistake. See, justified leading. You said 7.04.
Yeah.
7.04 is for leading PE. I was calculating trailing PE.
Okay.
You calculated it or not? This one.
I did this 0.5 DPS upon ye R minus D. DPR upon R minus D.
Why? Because there is 1 plus G also mentioned na, in the
Yeah, yeah,
formula.
yeah, yeah.
Then
Yeah,
here also I
actually,
mentioned that 1 plus G.
yeah, actually, I thought that like I did it. Yeah. Sorry.
So this is wrong.
Yeah. Yeah. Actually, that's right, but that's the second part of the sum.
Hmm.
Sorry. So the answer for this one, leading, is 7.04.
But let's do this one
Yeah.
now. Let's
Yeah.
stick to trailing first of all.
1.5 divided by 3. Yeah, 7.29.
Okay. Now coming to leading PE. Leading PE will always be lower than the uh,
Okay.
trailing PE,
Okay.
assuming that the earnings will grow.
Okay.
Okay. Now you calculate this part.
It's 7.04. I did that.
Okay.
So 2 minutes. I'm writing it down. Done, sir.
Yeah. 1 minute. The next one. Okay. See, all these are very easy sums only. Okay.
Yeah.
You just try all this at home as your homework. Did you do
Yeah.
all the remaining one previous one?
Previous one. No.
I think I told you to do, right?
Yeah. It was this one. Yeah, I did 2, 3.
No, see, you have to make sure that all whatever I'm asking you to do, you are
Yeah.
doing it. Okay. Reason being, otherwise, then lack of practice can put you into deep trouble then later on.
Okay.
Okay, then multi-period models. These are characteristics. You can go through it for a minute. See, earning growth initially very high happens. Okay, then when it is transitioning, above average happens, but falling. Then at maturity, it is stable. Similarly, capital investments initially significant requirements, then decreasing, then stable. Just go through this table.
Okay, sir.
This is, we will see this H model. Okay, in some time we'll see. See, basically the concepts of H model is, see, when we say two-stage dividend discount model, see, it is growing at 15% initially. Then it grows at 3% forever.
Okay.
Now, is it practical that suddenly growth is coming from 15% to 5%?
No.
No, that means practically it is not going to happen like this. It will slow steadily come down.
Yeah.
And that's why we have H model. So which says that from 15% initially, it will slowly coming down to 3%.
Okay.
Then from there, it is becoming stable.
Okay.
Okay, that is the concept. And there is a formula for H model that we will see. Okay. Then what growth rate we will take here? So
3.
no. Then you are assuming that it is directly jumping. No? So this is how it is going, right? So it's 3 we certainly should take. This is one part. This
Yeah.
is for Gordon growth, continue,
Yeah.
this constant growth. But for this period of time, what growth should I take? Here it is 15. Then slowly it is coming down. I will take this
Average.
average, this one.
Average.
So this is what that formula is about. That when it comes, we will see that. So I will take in between this average.
Okay.
Same way here.
Yeah.
No, different stages of growth. Terminal value means this part is called terminal value, from where it will start
Be
growing
constant.
constantly.
Okay.
Okay. At some point in the future, we assume dividends will grow at a constant.
Okay.
That is called terminal value. Estimating terminal value. Yeah, that means this value before, from where it is continuously, constantly going to grow. Just go through this question now.
Yeah.
Level partner is expected to have earnings in 10 years, $12 per share. Dividend payout ratio of 50% and the required return of 11%. At that time, the dividend growth rate is expected to fall to 4% in perpetuity.
Okay.
And the trailing PE ratio is forecasted to be 8
8
times
times.
earnings. Okay. Estimate the terminal value at the end of 10 years using Gordon growth model and PE multiple. Okay. So level partner is expected to have earning in 10 years of $12. So this is 10-year, $12 per share. A dividend payout ratio of 50%. So this is the earnings.
Earnings. So dividend
Dividend
will be
payout ratio is equal to 6.
6. Dividend will be 6. Okay. Required is 11%.
Dividend payout ratio is 50%. Um, 6. Okay. Required return is 11%. Okay. At that time, the dividend growth is expected to fall to 4% in perpetuity. Okay, so this is fall to go 4% in perpetuity.
Okay.
And the trailing PE ratio is forecasted to be 8 times. So 4% it is growing.
Yeah.
Dividend growth is expected to fall to 4% in perpetuity, means constant growth.
Yeah.
So into 1 plus 4%, calculate how much it comes to. 6 into 1 plus 4%.
6. 6.24.
6.24.
24.
So divided by, so this becomes my D1 divided by R minus G. R is 11
R is
percentage
11.
minus G is
4. 7.
4 percentage. Just calculate this.
0.8914.
Hmm?
89.14.
89 point.
14.
This will push the price 1 year back. Okay, because
Okay.
P0 is equal to D1 by R minus G.
Ha.
So if this is the case, then this value is P0 1 year
Ha.
back.
Ha.
89.14. Okay, this is the terminal value from where the
So
constant growth is beginning.
we'll add 4% to it now because it is growing for 4%.
That we added here, right? From 6 we
Yeah,
got 6.24.
that
That
we
is what
added
the price.
but if the company's dividend is growing by 4%, the company's share price will also minimum grow by 4%.
No, that is factored in already. Using dividend
Okay.
Gordon growth model, the rate at which growth is going to happen, that is all factored in. Na?
Okay.
Okay. Then what is the question? But they are saying now in this case, what is the P ratio and the P multiple? So this is the price. Earning
Ha.
is 12 rupees.
12 rupees.
So this is 89.14 divided by earning is 12. Okay. So
7.42.
7.42 is the P ratio.
Yeah.
But they are saying it is trading at 8.
Okay.
Correct? It is
Yeah.
trading at, no, 10,
It's 8 times.
trading at 8. So that means it is trading at 8 means this is the earnings 8 times.
Yeah.
Okay, that means it is not trading at 89.42. It will be trading at 8 times. That means price is equal to PE or uh, uh, see, price is equal to PE into earning. This is the formula. Okay.
Ha.
So PE is what? 8 times they said.
Ha.
Into earning is 12. So that comes to 96.
Ha.
So it is not trading at 89.14. It is trading at 96 rupees.
Okay. 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 So
It
as
should,
per
as per this constant growth,
it
the
should trade
Gordon growth,
at
it should at 89.
89.14.
As per, see, now this is what I was telling you. Like, see, you see, different method is giving you different value,
Yeah.
and which one is right? Nothing like that.
Yeah.
It
Yeah. Yeah.
depends upon you. I might select this one. You might select PE
Yeah.
ratio.
Yeah. Got it. Ha.
So terminal value is 96.
Ha.
Then valuation using the two-stage model. Two-stage model. This is also normal one only. Just go through this.
Yeah.
Sea Island Recreation currently pays a dividend of $1. Okay, and analysts forecast a growth rate of 10% for the next 3 years, followed by 4% growth in perpetuity thereafter. The required return is 12. Calculate the current value. Okay, so see, from 10% it is jumping to 4%,
4%.
which practically will not happen like that. Okay, so right now it is currently $1, and so currently it is 1, and it is growing at the rate of 10% for the next 3 years. So into 1 plus 10%, calculate
10 1.1.
So 1.1 again into 1 plus 10%,
1.21.
again into 1 plus 10%.
1.331.
Okay. Then after that it will grow at 4%. So into 1 plus 4%. And this is the terminal value, right? Continuously growing. 4% is
1.3424. 3824. 42.
3842 divided by R minus G. R is 12%. Minus growth is 4%. Now you calculate the value, it will push the price 1 year back.
$17.3.
17.3. Okay, now what is the question? Calculate the current value per share. So they are asking right now what is the price. So that means this is the cash flow for me for year 3.
Okay.
This is for year 2. This is for year 1. Okay, so now one way manually what you can do is this is 1.10 divided by required is 12%. You can do like this manually. This you should add both. Okay, 1.331 plus 17.3. You can do like this. Or you
CF
can
function.
you can go to cash flow function. CF0 is 0, cash flow 1, 2, 3, you can put the number, and then interest is 12%. You take, calculate the net present value.
Yeah. $15.2.
Okay. Hmm. 15.2. Fine. Okay.
Yeah.
Dividend of a value of a non-dividend paying stock. So it is not paying non-dividend paying stock. Okay. Just go through this. Okay, so it is not going to pay dividend for the next 4 years. No dividend. Recently reported earnings of 1.50 and expected growth is 15%. So for the next 4 years, and then only it will start paying dividends 20%. Okay. So earning is currently 1.450. So currently earning is 1.50 earning. So 1, 2, 3, 4. And these earnings will grow at the rate of 15%. Beginning in year 5, expected to distribute 25% of its earning. So this is the fifth one. Okay. So from here only, so 25% of its earning. So we need to know what is the earning here. So it will be 1.50. So now directly you can shift the earnings into 1 plus 15% for 4 years. Just calculate.
2.62.
4 or 5 years. Wait.
4 years.
Beginning in
No?
year 5.
So
1,
till
2,
4.
3, 4. Beginning in year 5. That means here they will pay. Starting itself, they are going to pay.
$2.62.
Okay.
Yeah.
So now 15%. Okay, how much you said?
2.62.
2.62 is the earnings.
Yeah.
Now from here on they are going to pay 20%. So into 20% calculate for dividend.
20% is
Of 2.62.
0.5247.
0.5247. Okay. Then expected to pay 20% in the form of dividend and to have a constant growth of 5%. So from here 1 plus 5%. Calculate 5th year constant growth.
0.55.
Divided by R minus G. R minus G.
R is 12 minus 5, which is 7.
12% minus 5%. Now calculate this. It will give you the price for the 4th year. Calculate the value shares today, they said. Okay. Then we have to
7.87.
then you have to discount it because they said what is the value as of today. So 1 plus 12% raised to 4. 7.86 is it? Yeah, 87. It's okay. Correct only. Calculate. This is the value at time 4. Now this is value at time 0.
5.
Okay. Then H model.
Sir, what did we do here? Can you explain it again, like a summary?
Yeah. See, 4th year onwards only they are paying dividend. So 4th year, this much dividend we got it. And from here on, it will grow at the constant growth rate of 5%. So we are applying Gordon growth model. And we calculated the value 7.87 for the 4th year. But the question is, what is the value right now? So I discounted it. There is no other cash flow in between.
Yeah.
Earlier there were cash flows in between, so we accounted that as well. There is no cash flows here. See, there were cash flows in between.
Hmm.
So we accounted all those things.
Yeah.
Now there is no cash flow. Now it's like only 17.3 you are going to get, they said. Okay, then only this much you have to discount.
Okay.
Yeah.
Okay. Yeah. Okay, got
Okay.
it. So 1.5 is the earnings that will be growing for 15% for
Mm.
the 5 years, and after that, 20% will be distributed as dividend. So that we
Mm.
got dividend. Okay. And then that will be growing for 5% perpetually. Okay.
Okay.
So we got the share. Yeah. Okay, got it.
Then H model. See, now H model. Uh, okay. So you just go through this now. H model. Omega Food currently pays a dividend of 2. The growth rate, which is constant, which is currently 20%, is expected to decline linearly. See, this is the key point here. Linearly. It is not
Okay.
immediately declining. Declining linearly over the next 10 years. So graph wise, it is like this. Right now it is growing at 20 and slowly it is growing 20 percentage. Now slowly then it grows to,
12.
comes down to 5
5. Okay.
percentage and then constant. Okay, the required return is 12 percentage. Now how do I calculate it? So obviously this I will categorize into two parts. One is this one, constant growth,
Yeah.
and one is this one, average, this
Yeah.
in between growth. Okay, and then I will add up these two. That becomes H model. So H model says, so first I'll write the formula. So this is the formula according to H model. V0 is equal to D0 uh, into 1 plus long-term growth. GL means long-term growth. Then R minus long-term growth plus. So this is nothing but Gordon growth model only. Long-term growth means what? Constant growth, no?
Yeah.
Okay, this GL is also long-term growth, means constant growth plus. Now, so this is taking care of this part. Now plus that linear growth. See, linear growth is dividend. Normally, how do I say? Normally, it will be D0 into 1 plus G divided by R minus
Hmm.
G. Now, R minus G only I am taking here as well. Okay, but here, because it is, I don't know the growth rate, I need to take the average growth rate here. So because I have to
Okay.
take the average growth rate, so I will take like average of what number? Average of 20 to 5.
Yeah.
So 20 percentage, okay, which I will write as growth for short term
Okay.
minus growth for long term.
Okay.
Okay, so first I'll put the numbers. D0 is what? D0 is 2.
Two. So this first part is basically normal Gordon growth.
Gordon growth, yeah, yeah.
Yeah.
Growth is 5 percentage divided by required rate of return is 12 percentage minus 5 percentage plus. Now here also, okay, now here 2. Now growth is initially 20 percentage minus 5 percentage. So how do I take the average? Average is the, so I will take half of this. Okay, so
Okay.
half means what? This is for, uh, this is happening for how many years? Um, 10 years, right? Over the next 10 years. So half means 10 by 2. Okay, that means 5 years. I will multiply by 5. Okay, so half as in what? See this one. Half life in years of high growth.
Okay.
So half life T by 2. Okay,
Okay.
so half. This is for 10 years, half. Okay, so that means I'm taking only 50% of all this growth. Okay, so yeah, so this will come to now 2 into this is 5 into 15% divided by 7%, and here also 7%. Calculate this numerator.
15.
How 15?
15 into 5. Sorry. Into 2. 150, sorry.
What? How 150? 2
Which
into
new?
1 plus.
Acha, this you numerator. Okay. Sorry, sorry. 2.1.
Okay, now you calculate this and add up.
Yeah. So the first part is 30.
Hmm.
Second part is 21.42.
Hmm. So,
51.42.
yeah, so
Yeah.
so this is the formula you have to remember.
Yeah, okay.
Okay.
Just a minute, sir. I'll write it down.
Okay.
Done, sir.
Fine. We'll stop now here, okay, for today.
Okay.
We'll then continue this tomorrow.
Okay.
Okay.
Yeah.
Okay. Okay, bye.
Bye.